Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines. Get ready for a deep dive into the global market response to Donald Trump's victory. In the U.S. presidential election, we've got a stack of fascinating articles to unpack. From Bloomberg to the Wall Street Journal, the market seems to be on a roller coaster ride, trying to figure out what a Trump presidency means for the economy.
It's a fascinating mix of exuberance and apprehension. Some investors are clearly betting on a Trump bump, while others are bracing for potential volatility.
Let's start with the global landscape. CNBC is reporting mixed reactions across Asia-Pacific markets. Japan's Nikkei 225 surged by a significant 2.61%, while South Korea's Kospi and Hong Kong's Hang Seng Index saw declines.
The Nikkei surge is particularly interesting because it seems to be driven by a combination of factors. The U.S. election results certainly played a role, but the Bank of Japan also released meeting minutes, also reported by CNBC, indicating a potential rise in interest rates. This signals confidence in Japan's economic prospects independent of what's happening in the U.S.
So it's not just a knee-jerk reaction to Trump's victory. There are underlying economic forces at play. What about Europe? How are markets reacting there?
CNBC tells us European markets are largely up, with the pan-European stocks 600 experiencing a gain of over 1%. This could be driven by anticipation of a business-friendly environment under a Trump administration. Though, as Bloomberg reports, some analysts are concerned about potential trade tariffs.
That makes sense. Europe is a major trading partner with the U.S., so any talk of tariffs is bound to create some uncertainty. Okay, let's turn our attention to the U.S. What's happening with U.S. stock futures?
Bloomberg is reporting strong positive movement, with the Dow Jones Industrial Average futures surging significantly. This points to investor anticipation of Trump's policies, specifically tax cuts and deregulation, which are perceived as potentially boosting corporate profits.
It definitely feels like a Trump trade is already brewing. As highlighted by Bloomberg and the Wall Street Journal, investors are piling into assets that are expected to benefit from Trump's policies.
Absolutely. And this Trump trade extends beyond traditional sectors like energy and defense. Bloomberg even reported that Bitcoin's surge to an all-time high near $75,000 could be part of this phenomenon.
Bitcoin at an all-time high. That's wild. Is this just because Trump has previously expressed support for cryptocurrency, as MarketWatch suggests?
It's likely more nuanced than that. While Trump's stance on cryptocurrency is a factor, the surge could also reflect a broader trend of investors seeking alternative assets in times of uncertainty. Bitcoin, being decentralized and outside the control of governments, is seen by some as a hedge against potential economic turmoil.
So it's not just a bet on Trump, it's a bet on a changing financial landscape. This really underscores the sense of uncertainty that surrounds a Trump presidency. On the one hand, you have investors bullish on deregulation and tax cuts. On the other hand, there are concerns about inflation and trade wars.
Precisely, and those concerns are reflected in some of the market movements we're seeing. For instance, Bloomberg is reporting that the U.S. dollar is experiencing its most substantial gain in recent years.
What's driving that surge? Is it just a knee-jerk reaction to the election results?
It's more likely tied to the perception that Trump's policies will be inflationary, which could lead to higher interest rates. The Wall Street Journal reported a significant jump in the yield on the 10-year U.S. Treasury note, reflecting this sentiment.
So the market is already pricing in the possibility of a Trump-fueled inflation spike. That's a bit unsettling. And Bloomberg even mentions that the 10-year break-even rate, a key indicator of expected inflation, is also surging.
That's right. And this raises an important question. How will the Federal Reserve navigate this complex landscape of potential inflation and economic growth?
The Wall Street Journal and CNBC both report that the Fed is still expected to announce a quarter-point rate cut this week, but their future decisions seem a lot less certain.
Absolutely. The Fed is in a delicate position. They want to support economic growth, but also need to manage inflation expectations. Trump's policies could throw a wrench in their plans, forcing them to make tough decisions in the coming months.
Speaking of specific impacts, Bloomberg is reporting a massive surge in Tesla's stock, up to 15%.
Elon Musk's close relationship with Trump is definitely a factor here. Investors are anticipating that Tesla will benefit from a less stringent regulatory environment. Bloomberg points out that while Trump previously criticized electric vehicles, his stance has softened since Musk's endorsement.
So is this a clear win for Tesla and the EV sector under a Trump presidency?
Not necessarily. While Tesla might benefit, other EV manufacturers could face headwinds. Bloomberg cautions that Trump's policies could lead to reduced tax incentives for electric vehicles, which would benefit Tesla but potentially harm other EV companies that rely more heavily on those incentives.
That's a great point. The impact of Trump's policies is not always straightforward. What about other sectors that might be impacted?
Well, the Wall Street Journal is reporting concerns about European pharmaceutical and automotive companies. They are seen as potentially at risk due to the possibility of new U.S. tariffs under a Trump administration.
That makes sense. These sectors rely heavily on exporting to the U.S. The Wall Street Journal specifically highlights that new tariffs could significantly impact their profitability.
This underscores the interconnectedness of the global economy. A policy change in one country can have ripple effects across industries and continents. What stands out to you about these sector-specific impacts?
Honestly, it's the potential ripple effect that's most striking. A policy aimed at boosting one sector like Tesla and autonomous vehicles could have unintended consequences for others like European pharmaceuticals.
That's a crucial point to consider. The interconnectedness of the global economy means that even seemingly targeted policies can have far-reaching implications.
It makes you wonder if these market reactions are overblown, or if they're an accurate reflection of the potential changes ahead.
That's the million-dollar question, isn't it? We're seeing a mix of optimism and apprehension, of calculated bets and knee-jerk reactions. It's going to take time to see how this all truly plays out. It's almost like watching a giant economic experiment unfold in real time, and the variables are so complex.
Definitely feels that way. One of the most perplexing variables is the U.S. dollar. The Wall Street Journal's coverage really delves into this. Trump has historically favored a weaker dollar, but the market seems to be reacting in the opposite direction.
It's counterintuitive on the surface, right? But investors are looking beyond the rhetoric. They believe that despite Trump's pronouncements, his policies will ultimately lead to a stronger dollar.
So it's a case of the market interpreting the potential consequences of those policies, regardless of what's being said directly.
Exactly. And the key driver here is interest rate differentials. If Trump's policies do indeed fuel inflation, as many anticipate, the Federal Reserve will likely be forced to raise interest rates higher than planned.
Higher interest rates in the U.S. would make the dollar more attractive to foreign investors, pushing up its value.
Wow.
So we're witnessing that play out right now with the dollar's surge.
Precisely. And a stronger dollar has repercussions beyond just currency markets. It can impact everything from U.S. exports to the profitability of multinational corporations. It ripples outward.
A constant reminder of how interconnected the global economy truly is. Speaking of interconnectedness, let's shift our focus to emerging markets. Bloomberg had a piece on this, highlighting how emerging market currencies took a hit after Trump's victory.
Yes, their reporting focused on sharp declines in emerging market currencies, particularly the Mexican peso, in response to the election outcome.
Makes sense. Trump's protectionist stance, particularly his talk of tariffs, tends to make investors wary of emerging economies that rely heavily on trade.
The possibility of trade wars and increased tariffs injects uncertainty and risk aversion into the equation, often leading to capital flight from emerging markets.
So while U.S. markets might be experiencing a Trump bump, other parts of the world are feeling the tremors.
It highlights the uneven nature of global economic shifts. One region's gain can be another's loss. This creates both opportunities and challenges for investors. Sectors like traditional energy and banks may benefit from Trump's policies, while others like renewables and export-oriented businesses could face headwinds.
It's a complex landscape for sure. Amidst all this noise, what should investors really be focusing on?
The key is to look beyond the headlines and focus on the fundamentals. Look at companies with strong balance sheets, solid earnings growth, and a proven track record of navigating economic cycles.
Essentially, don't get swept up in the hype. Make informed decisions based on sound investment principles.
Exactly. This is a time for prudence and careful analysis, not impulsive reactions. The market is likely to remain volatile in the coming weeks and months as the implications of a Trump presidency become clearer.
And speaking of volatility, what about the Federal Reserve? They're in a very challenging position right now.
Indeed. They're tasked with balancing the need to support economic growth with the risk of runaway inflation. The Wall Street Journal highlighted that while the Fed is still expected to cut interest rates this week, their future decisions are far less certain.
It's a delicate balancing act. If Trump's policies trigger a surge in inflation, the Fed might have to reverse course and start raising rates sooner than anticipated, which could potentially curb the stock market rally we're currently seeing.
Precisely. It's a classic example of the push and pull between fiscal and monetary policy. Trump's actions on the fiscal side could force the Fed's hand on the monetary side with unpredictable consequences.
It's a high-stakes game of economic chess with the global economy hanging in the balance. We've talked about sector-specific impacts and the Federal Reserve. But what about the broader implications for the U.S. economy as a whole?
That's a crucial question that several of our sources are grappling with. The Wall Street Journal in particular offers some interesting analysis. They suggest that Trump's economic agenda goes beyond just boosting GDP.
They mentioned a focus on restoring good jobs and reducing dependence on China. So it's about more than just economic growth. It's about reshaping the American economy and its role in the global landscape.
Precisely. And that's where things become even more complex and nuanced.
Because those goals might not always align with traditional economic metrics.
Exactly. Trump's actions could lead to outcomes that are positive from a nationalistic or political standpoint, but potentially negative from a purely economic perspective.
For example, tariffs might protect certain American industries, but could also lead to higher prices for consumers.
Exactly. It's a trade-off that policymakers and voters alike will have to wrestle with. There are no simple answers or solutions in this complex economic equation.
This emphasizes how important it is for investors to stay informed and truly understand the multifaceted implications of these political and economic shifts. It's not just about picking winners and losers in the stock market.
It's about grasping the forces shaping the world around us. And that's precisely what we aim to do here on the Deep Dive, to provide you with the context and insights you need to make sense of this ever-evolving economic landscape.
We've covered a lot of ground in this deep dive, from Asia-Pacific markets to the Federal Reserve's dilemma to sector-specific impacts and the global implications. It's clear that the market is grappling with the uncertainty of a Trump presidency.
And that uncertainty is the biggest takeaway from all of this. We're seeing these short-term trends emerge, the Trump trade, the dollar surge, but the long-term impacts are still very much a question mark. Investors are placing bets based on their expectations, but as we've discussed, those expectations could easily be upended.
It's almost like we're at a crossroads, a moment of transition where the old rules of the game might not apply anymore.
That's a great way to put it. The global economic order has been in flux for a while now, and a Trump presidency could really accelerate the pace of change. We're already seeing signs of this with the potential for trade wars, shifting global alliances, and a reassessment of globalization itself.
It's definitely a time of disruption, and that disruption creates both risks and opportunities. So for our listeners who are trying to make sense of all this, what advice would you give them? How should they navigate this uncertain terrain?
First and foremost, I'd say stay informed. Don't bury your head in the sand. Keep a close eye on what's happening in Washington, on global trade negotiations, on the Federal Reserve's actions. Understanding the forces at play is crucial right now.
Knowledge is power, especially in times of uncertainty. What else should investors keep in mind?
I'd advise them to be cautious and strategic with their investments. Don't make rash decisions based on fear or hype. Stick to your investment plan, make sure your portfolio is diversified, and focus on companies with strong fundamentals.
Essentially, weather the storm and position yourself for long-term success. Don't get swept away by the short-term waves.
Exactly. And finally, I'd encourage everyone to embrace the learning process. This is a period of immense change, which means there's a lot to learn and absorb. Stay curious, ask questions, and don't be afraid to challenge your assumptions. The more you understand about the forces at play, the better equipped you'll be to navigate the economic landscape.
That's great advice. It's a time to be both cautious and curious, to stay grounded while also keeping an eye on the horizon. And we'll be here to help guide you through it all. We'll continue to bring you deep dives into the most important financial news and trends, helping you cut through the noise and get to the heart of what matters.
We'll delve deeper into specific sectors, analyze emerging market trends, explore the long-term implications of this presidency on the global economy. Stay tuned for those future episodes.
We'll be here every step of the way. And remember, knowledge is power, especially in times of uncertainty. That's what the Deep Dive is all about, empowering you with the knowledge you need to make informed decisions and navigate the complex world of finance.
Thanks for joining us on this deep dive.
And we will see you all tomorrow morning for more market updates from major financial magazines.